If you're following our Global Economic Outlook series, hit subscribe to stay updated with new country releases. Tunisia's economy expanded by just 1.4% in 2024, with momentum faltering into early 2025. Real GDP growth slowed to 1.6% in Q1, then improved to 3.2% in Q2, but the rebound remains fragile. This is the story of an economy caught between marginal gains and long-standing constraints. Labor market conditions underscore the softness. Unemployment stood at 15.7% in Q1 2025, essentially unchanged from late 2024, with joblessness among young people remaining elevated. Employment growth has been patchy, with formal hiring restrained by weak domestic demand. Tighter credit conditions and cautious business sentiment limit job creation. Regional disparities in participation continue to weigh on aggregate outcomes, with household purchasing power only gradually recovering. Private consumption is steady rather than strong, fitting the tone of stagnation. This cautious consumer behavior reflects the underlying economic fragility. Manufacturing and construction stayed subdued, leaving the overall picture closer to stagnation than sustainable growth. Price dynamics offered one clear positive. Headline inflation eased to 5.4% in June 2025, the lowest since May 2021, down from readings above 7% in 2024. Disinflation broadened beyond food to transport and several core categories. This reflected slower import cost pass-through and better domestic supply. Even so, price levels remain significantly higher than 3 years ago. The interest rate backdrop shifted gently. After holding at 8.0% at end 2024, the central bank kept the policy rate unchanged at 7.5% through mid-2025. This level remains restrictive in real terms given the fall in inflation, supporting further disinflation but limiting credit growth to firms and households. Lending officers report tight underwriting standards and higher collateral demands. Public finances anchor the structural side of stagnation. Government debt was 79.8% of GDP in December 2024, lower than 84.6% in 2023, yet still heavy for a slow-growing economy. High interest costs and sizable amortizations compress budget flexibility, crowding out priority capital spending and social investment that could lift potential growth. With financing relying more on domestic sources, banks deploy balance sheets toward sovereign paper, reducing room for private sector credit. That nexus between debt management and bank liquidity defines Q2's sluggish tone. External balances add to the caution. Tourism receipts are normalizing, but import needs remain large. Scarce concessional inflows keep pressure on reserves management. Businesses run with thin inventories and delay new projects, which dampens multiplier effects even when headline GDP shows quarterly relief. The 3.2% growth should be read as cyclical noise around a flat trend rather than a decisive break from the low-growth path. Stability in prices and rates is helpful but not yet decisive for activity. With inflation at 5.4%, the real policy rate has turned positive, anchoring expectations and guarding against second-round effects, yet also translating into higher real borrowing costs. Firms facing a 7.5% policy benchmark and cautious banks postpone expansion or pivot to internal cash generation, which limits capex. On the household side, wage gains are uneven and concentrated in public sector segments, constraining discretionary spending. Unemployment at 15.7% keeps overall labor income below what's needed to ignite a durable consumption-led cycle. The labels stagnation and Q2 go together because improvement coexisted with weak credit impulse. Policy choices revolve around sequencing, sustaining disinflation without choking activity, gradually normalizing the policy rate as inflation remains anchored, and protecting capital outlays that raise productivity. Lower inflation creates space for small, data-dependent rate adjustments, but the debt-to-GDP starting point argues for a cautious approach to stimulus. Any fiscal room from lower interest outlays should prioritize targeted social protection logistics improvements that reduce non-tariff costs for exporters and maintenance spending that preserves existing infrastructure. On the private sector side, easing bottlenecks in permits, customs clearance, and payment delays would support working capital and reduce the need for costly overdrafts. These steps won't change Q2 overnight, yet they shape the transition from shallow to durable growth. The second quarter presented a mixed ledger. GDP annual growth at 3.2%, unemployment at 15.7%, inflation at 5.4%, the policy interest rate at 7.5%, and government debt at 79.8% of GDP as the latest full-year reading. Those figures jointly describe an economy edging away from the inflation shock of 2023 to 2024, but still bounded by high debt, tight credit, and underpowered job creation. Until investment and employment accelerate together, Tunisia's quarterly expansions are likely to look more like plateaus than ramps, confirming that stagnation remains the operative description of Q2. Looking ahead to late 2025, three factors will determine the trajectory: sustaining lower inflation, easing the policy stance, and mobilizing external and domestic financing for productivity-raising projects will determine whether the gentle mid-year bounce broadens into trend growth rather than another pause. Case Study 1. Tourism receipts are normalizing after pandemic disruption. Hotel occupancy rates show seasonal improvement, but international arrivals remain below 2019 peaks. While tourism provides foreign exchange relief, the sector's contribution to overall employment remains constrained by seasonal volatility and infrastructure bottlenecks. Coastal regions benefit disproportionately, while inland areas see limited spillover effects, highlighting the challenge of geographically balanced recovery. Case Study 2. Manufacturing remains subdued despite some export market recovery. Textile and automotive component producers face higher input costs and supply chain disruptions. Export competitiveness has eroded due to energy cost increases and logistics delays, limiting manufacturing's ability to drive broader economic momentum. Formal manufacturing employment shows minimal expansion, reflecting cautious hiring practices and automation trends that reduce labor intensity. Case Study 3. The banking sector illustrates the credit constraint mechanism. Banks hold significant government securities, limiting lending capacity to private enterprises. Credit allocation favors low-risk government paper over higher-risk business lending, creating a crowding-out effect that reinforces the investment slowdown. Small and medium enterprises report increased collateral requirements and longer approval processes, limiting their ability to finance working capital and expansion. The analysis reveals Tunisia faces both structural and cyclical challenges. Structural issues include high debt burdens, institutional bottlenecks, and productivity gaps that require long-term reform. Cyclical factors involve monetary policy transmission, where high real interest rates and tight banking conditions amplify the structural constraints rather than offset them. Effective reform requires careful sequencing, stabilizing inflation first, then gradually easing monetary conditions while implementing structural changes. Regional comparisons show Tunisia's disinflation progress outpaces neighbors, but growth performance lags countries that maintained fiscal discipline earlier. Global conditions present mixed signals. Declining commodity prices help inflation but reduced global growth limits export demand and foreign investment inflows. Three critical insights emerge from Tunisia's Q2 performance. First, the 3.2% growth uptick masks underlying structural weaknesses that prevent sustained acceleration. Second, policymakers face difficult trade-offs between maintaining price stability and supporting growth, with limited fiscal space constraining options. Third, the window for implementing structural reforms is narrowing as demographic pressures and debt dynamics create longer-term sustainability challenges. For investors, Tunisia presents a cautious optimism scenario where disinflation progress creates opportunities, but structural constraints limit upside potential in the near term. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.